All right, let's talk about U.S. income taxes. I know, for most of us, just hearing those words can bring on a headache. But what if I told you the whole system is actually, well, kind of simple at its core? Stick with me, because in the next few minutes, we're going to tear it all down, and I promise you are going to get it.
Yeah, this number pretty much says it all, doesn't it? Back in 2014, the US federal tax code was a whopping 74,608 pages long. I mean, no wonder we all feel completely lost when April rolls around. You could almost think it's meant to be confusing, right?
It is absolutely overwhelming. But here's the good news, the secret, if you will. You do not need to read all 74,000 plus pages to get a handle on your taxes. The main ideas, they're actually surprisingly simple, and that's exactly what we're going to do today. Break them down, one piece at a time.
So, how are we going to do it? Well, we can make sense of this whole thing by looking at just 5 key building blocks. That's it, just 5. Think of them like the corner pieces of a giant puzzle. Once you know where they go, the whole picture starts snapping into place, and it all becomes way clearer.
Okay, section 1. Let's start with the absolute foundation of the entire U.S. federal income tax system. It's this idea of a progressive system. And honestly, if you understand this one concept, you're already halfway there to understanding how your tax bill is calculated.
So, what in the world does progressive actually mean? It's really simple. The more you earn, the higher the tax rate you pay. But, and this is a huge but, only on your additional income. This is probably the biggest myth in all of taxes. You do not pay the same high rate on every single dollar you make. Let's just bust that myth wide open right now.
I want you to picture your income like it's climbing a staircase. Everyone, and I mean everyone, starts on that bottom step. Your first chunk of income gets taxed at that low 10% rate. Once you fill that step up, the next bit of money you earn spills over to the next one, which is taxed at 12%. And it keeps going like that. You only pay those higher rates on the money that actually makes it to those higher steps. This is so important. You are never, ever punished for earning more money. It just doesn't work that way.
All right, so now that we've got that core principle down, let's get personal. We're moving on to the 2 numbers that are the starting point for literally every single tax return: how much money you made and what your filing status is. To make this all a little less abstract, let's create a hypothetical taxpayer to follow. Let's call her Josie. So Josie earned a gross income of $65,000 last year, and she's filing as single. We're going to follow her story to see exactly how this all plays out in the real world.
Now, this filing status thing, it's basically the government's way of asking about your life. What was your deal on the very last day of the year, December 31st? Were you single, married, supporting a family? And this choice is a big one because it really sets the stage for everything that comes next, especially how big your first tax break is going to be. Okay, this leads us to our next major building block, and it's a huge one. The government does not tax you on that big gross income number. Nope. Before they do anything, you get to shrink that number down. And the tool you use to do that, it's called a deduction. Its only job is to lower the amount of your income that can actually be taxed.
And the simplest, most common way to do this is with something called the standard deduction. Seriously, just think of it as a giant freebie discount from the IRS. For 2025, someone filing as single, like our friend Josie, gets to just, poof, make $15,750 of her income totally tax-free. It's automatic, no questions asked.
Now, you actually have a choice here. You can take that easy, automatic, standard deduction, or you can choose to itemize. Itemizing is basically where you get out a calculator and you list out all your specific deductible expenses, things like mortgage interest or big charitable donations. So why would you do all that extra work? Well, you'd only do it if your grand total of itemized expenses is bigger than the standard deduction. It's just simple math.
So for Josie, the choice is a no-brainer. She's definitely taking the standard deduction. And watch what happens. We take her 65 grand in income, we subtract that 15,750, and bam, her new number is $49,250. This is her taxable income. This is the magic number that we're going to use for the next step. Forget the old number. This is the one that matters now.
Okay, we've got our key number, $49,250. Now we get to do the fun part. We're going to take this number and run it through those tax brackets we talked about. Remember that staircase? We're about to see it in action and calculate Josie's actual tax bill. Don't worry, it's just a little bit of simple multiplication and addition. So here they are, the 2025 tax brackets for a single filer. You can see the different steps on the staircase, right? Different rates for different chunks of income. Josie's taxable income,
That $49,250 is going to spill across the first 3 of these brackets. Let's walk through it. First up, that very first chunk of her income gets taxed at that low 10% rate. Then, the next big slice of her income, that all gets taxed at 12%. And see that only the tippy top portion of her income, just the last little bit, spills into that 22% bracket. So, when you add up the tax from each of those 3 buckets, her total tax bill comes to $5,749. Now, this lets us clear up 2 really important terms people mix up all the time. Her marginal tax rate is 22%. That's the rate she paid on her very last dollar of income. But her effective tax rate, what she actually paid on average across her whole taxable income, is only 11.7%. See, that's why you should never be afraid of moving up a tax bracket. Okay, so we've calculated Josie's initial tax bill. But hold on, we're not quite done yet. There's one more building block to go, and believe me, this one is the superhero of tax breaks. It's even more powerful than a deduction. It's time to talk about tax credits. I mean it. This is the most powerful tool in the entire tax code. A tax credit is a direct dollar-for-dollar reduction of the tax you owe. It's not complicated. If you owe the government $1,000 in taxes and you have a $200 credit, your tax bill is now just $800. Boom! It's that simple and that awesome. So let's be super clear about the difference. A deduction lowers your income before you calculate the tax. A credit, on the other hand, lowers the final tax bill itself. Think about it for Josie. A $1,000 deduction would save her $220, but a $1,000 credit, that saves her the full $1,000. So yeah, a tax credit is always more valuable. And you can actually see this magic happen right on the tax form, the 1040. Now, some credits are so powerful, they're called refundable, and this is where it gets really interesting. Let's say your tax bill is only $500, but you qualify for a $1,000 refundable credit. The government doesn't just zero out your bill. They actually have to send you the other $500 back as part of your refund. How cool is that? And there you have it. Those are the big building blocks. Once you really get how the mechanics work, the progressive brackets, the deductions, the credits, you can stop just reacting to your taxes and start planning strategically. So let's look at a few ways you can use these rules to your advantage all year, not just when you're scrambling in April. So here are just a few of the smartest strategies out there. Maxing out contributions to retirement accounts like a 401k, that's a classic move because it reduces your taxable income right off the top. Same with a health savings account. If you're someone who itemizes, you could try bunching your charitable donations to get over that standard deduction hurdle. If you're an investor, look into tax loss harvesting. It's a way to use your investment losses to offset your gains. Even just timing your income can matter. These are the kinds of proactive moves that can save you real money. So, that's basically the system. It's not some unknowable 74,000-page monster. It's really just a few core ideas. Progressive brackets, your income minus your deductions, and then those amazing credits to lower the final bill. It's all just a bit of math. So now that you know the rules of the game, the real question is, what's one smart move you're going to make for next year's taxes? Thanks so much for diving in with me on this.